Welcome to the Q1 2024 Manning Market Insight Series. I'm Josh Manning, Portfolio Manager and Founder at Manning Asset Management, and I wish to take you through 5 key areas today. From a portfolio performance perspective, the fund has delivered over 9.5% over the prior 12 months, and around 9% of that has been delivered as an income-based return to our investors on a monthly basis, consistent with the return objective and the philosophy of the fund. On a monthly basis, those returns have varied in a very tight range from 70 to 80 basis points, and we have stayed true to label in delivering consistently over that 8-year period on our RBA cash rate, plus 5% net of fees return objective. If we zoom out and take a longer term perspective, you can see that over all time periods, we have exceeded that return objective by circa 50 basis points, and really been true to label in managing the risk profile with what has been quite a ranging set of economic scenarios over that time period. Just to remind our viewers, our model is very much around what we call asset-backed securities or asset-backed financing, where we are a wholesale financier to non-bank lenders in the Australian market. What that means is that our finance that we provide to those lenders is secured by a range of underlying assets that support our capital. And then in the event of something occurring, those assets can be used to repay our capital through time. A big focus of us over the prior few years has been around also looking at increased asset security at the underlying level. So what we mean by that is focusing predominantly on mortgages, typically residential, in some cases commercial. And what that means is if that wholesale pool of many underlying loans fails to perform, those underlying loans are supported by a relatively low LVR property that can be sold and repaid our capital. And it's through those types of security measures we have consistently delivered on that return objective and never had a negative return from credit losses over that track record. From a market update perspective, the Australian economy has clearly surpassed its peak and firmly in contraction territory, characterised by rising unemployment, loosening bias by central banks, and weak business conditions. This is not too dissimilar to what we're seeing in the US, UK, Europe, and China. The key in this environment is to be focusing specifically on credit risk. We're less worried around interest rate risk and alike. The firm focus is on credit risk. What we're talking about there is that underlying borrowers in some of these wholesale finance pools may start to struggle more to make repayments. One of the benefits of our investment approach is that we're focusing on asset backing and the security of those underlying loans. So if there is a weakening in that credit risk and with borrowers, that there is an asset such as a property that can be sold to repay our capital. A key area we're watching is household balance sheets. We do think that is an area where stress will be felt. And you can see that in the household savings ratio, which historically peaked at around 20% and now approaching 0. And that's one of the reasons why we haven't had consumer loans in the portfolio for some time. From an asset allocation and investment strategy perspective, we remain very comfortable with how the portfolio is positioned today. If we look back 12 months in terms of the weightings to the various sectors that we participate in to today, you'll note that it is very consistent. And we say that because we have thought quite diligently around what the outlook entails and where we think some of the risks will present. And we've spoken before around the consumer loan, household balance sheet risk, which we are monitoring. So we feel like we're well positioned for the outlook, and we continue to support the lenders that we work with at the moment and continue to grow alongside them. Why we remain comfortable is very much around the nature of the facilities in terms of how we participate with them. Embedded within these is a lot of legal contractual rights that we have as wholesale financiers, which can protect our capital if arrears or different aspects that we track do deteriorate. So we spend a lot of time engaging with these lenders, spending time with them, monitoring their portfolio. And to be honest, we've been quite surprised by the resilience of the Australian economy, but also within these lender pools that we participate. So we are always taking a glass half empty approach. We are acknowledging the risks out there, but overall we've been very happy with how these lenders have managed that risk, and given how they're growing their businesses and our participation in that, we think it provides a very attractive position in the market to capture those quite strong returns that we're seeing, but importantly managing the downside risk. And that is absolutely central to everything that we do, is around capital preservation. The DNA of our firm is firmly centered around risk management. If there was one attribute you want from your investment manager, it's very good skills in this regard. When we talk about risk management, we're talking about in many different ways. It's both how we look at transactions that come across the desk, how we assess them, how we engage with different counterparties to really understand deeply, not just what the documentation says and what the marketing material says, but really getting under the hood, doing on-the-ground research, meeting with management, having that direct relationship gives us a real edge versus others who more look at it from a public market perspective. To give you a recent example, we had a transaction where we spent many months. There was literally hundreds of hours of work that we spent on this transaction, which was quite a significant and quite an attractive one for the fund. Through that process, we asked for a number of different risk management mechanics. They were documented in all the legals and put in the various reporting packs that we required. Just before we were about to close our transaction, that lender failed to give us one of our key risk measures, which we thought was unacceptable. And we actually pulled out of that transaction and didn't proceed with it. And what that demonstrates is just a very strong focus on portfolio quality. We think in this environment that is absolutely everything. And given our DNA is very much around capital preservation, so if we just step back and think about risk management, it is such a key area of focus for us. And we do take that very direct nature and going deep to make sure that when we're putting an asset in the portfolio, it is true to label and being truly through the economic cycle. The investment outlook will continue to have a number of known and unknown risks, where as a fund manager, it's our role to really identify and manage those within the asset class. We continue to have a bias towards proven sectors of the Australian credit markets, which have long track records that we can understand, assess, and structure suitable transactions given those data points. We note the emergence of a range of new credit funds in the Australian market that typically have a short track record, less experienced investment teams that may not have a track record in managing credit portfolios through varying market conditions. We continue to ask for sensible, proven risk management protections. For example, investing in sectors that do perform through the economic cycle and really avoiding those where we do think there is significant embedded risk. Examples of those could include corporate loans where there isn't an underlying asset that's protecting that loan, or construction finance where there is significant project risk and also the as-is valuation of those properties are extremely high. Our focus remains also on diversifying broadly and asking for suitable protections in the documents that can give us certain rights should portfolio or the broader market deteriorate. Manning has a range of very seasoned investment professionals that have over 100 collective years of experience in this asset class. And why we think that's so important is very much around protecting your money on the downside and taking advantage of the favourable conditions that are on offer today. Thank you for watching, and please feel free to reach out to the Manning team with any questions.